Be here, AFR Talk, and we've got a number of things that we are going to look at and talk about. The Dow futures, all the futures are up a little bit this morning. Of course, you know, or you may know, I'm having trouble with my internet, so I can't tell you exact numbers. Can't seem to. Oh well. Anyway, indices all down yesterday. Nothing great, no great shakes, but nevertheless, they are slated to be. They're flat right now. Dow futures, all the stock futures are flat right now. Stock futures pretty much unchanged again this morning, and based, everybody's waiting on Alcoa. I have no idea why. Alcoa certainly cannot be considered a bellwether for the future of earnings, but nevertheless, and by the way, Dow is expected to have pretty decent fourth quarter numbers. We'll see. But that's not coming out until after the close of the market today. So that's got, believe it or not, some optimism going on. Apparently there is some small business optimism and consumer credit making data that is bringing some optimism into the markets. So I'm not sure what that's all about or why that is, but nevertheless, that's what we have. European stocks are up, and that is primarily due to some things that came out of a benchmark of Vodafone over there, but also talking about U.S. earnings. That is the big story. U.S. earnings is the big story everywhere, and looking for some positive news. It's interesting, though. The interesting part about the European markets being in positive territory is the fact that the Eurozone unemployment rate just went from 11.7% to 11.8%. It is an all-time Euro era, since the Euro era has come into play. It's an all-time record for unemployment. Not a good thing. Everything over there seems to be going in the wrong direction, yet we see the markets over there are gaining. It's amazing to me. Germany data is showing exports dropped 3.4%. That is a huge drop in exports. And of course, this has got to be adding, or well, I guess it isn't. It ought to be adding concern to Europeans' largest economy. Germany is Euro's largest economy, and it continues to slip. And as we see it slipping into contraction, no one seems to be too concerned. Germany, the largest economy in Euros, was somewhat isolated from the rest of the Eurozone. Apparently, that is not the case right now. And it also continues to slip. Don't know if anybody cares, but it ought to be. Here's the good news. I'm being sarcastic now, but here's the good news. The Greek markets are in positive territory. Yes, the Greek stock market continues to be in positive territory. It's amazing to me how that is even possible. But anyway, Greek stocks rallied after Public Debt Management Agency said it successfully conned people. Oh, no, that's not what it says. Agency said after it successfully sold a total of $2.6 billion, or I'm sorry, it's actually 2.6 billion euros, which is $3.4 billion. In for 26-week Treasury bills. So that has obviously allowed them to borrow a little bit more money, as this agency has successfully managed somehow, way, shape, or form to sell more debt. Why in your right mind would anybody buy $3.4 billion worth of Greek debt? I'm telling you, it just goes to show the level of, now, obviously, is the return good? Of course it's good. It's got to be. Nobody's going to buy it unless the return is decent. It's the only way they have a shot at selling it. It's amazing to me that they sold it, and we've got European activity up on that good news. 888-589-8840. All right, let's turn to our problems here in America, our budget, our economy. Let me just talk a little bit about a couple things. One of the things that's very, very irritating to me is that this morning I heard an analyst this morning. I don't remember who it was because I heard way too many things this morning. But one of the analysts I heard was talking about this year, 2013, probably looking at about a 2% GDP growth. They were touting that as relatively good news for the market. And everybody around the table was agreeing that, yeah, 2%, well, not everybody. There was one that wasn't. 2% growth is good. I also saw John Allison. You might remember John Allison. John Allison, president of the Cato Institute, is also one of the folks I interviewed on a Fed Up DVD. If you haven't seen it, you need to see it. But one of the folks that, and I am likely doing a follow-up DVD to that. I've been asked by a Christian business network or a Christian business network to do somewhat of a follow-up DVD, and we're trying to kind of figure out the format of that and how we're going to go ahead with it. But it'll probably include a few more guests than guys like Ben Stein, Steve Forbes, John Allison, and T. Boone Pickens, and a couple others. But you got to watch this DVD for the follow-up DVD to have much of an impact. Now, look, 2% GDP growth has never been good, and it shouldn't be considered growth. Listen, is it better? See, here it's kind of like comparing the dollar to a bunch of other lousy currencies and saying the dollar is strong. Well, yeah, it's strong. I mean, it's like saying I have the fastest cow in a horse race when all the other horses are pigs. I mean, it's ridiculous. Of course the cow's going to win. I mean, it's going to look good. It's going to look strong. It's even going to look closer to a horse than something else might. It's crazy. But we're hearing about the strength of the U.S. currency and a 2% GDP growth. And here's the question that nobody asked this morning to this analyst that was talking about how great the U.S. economy is going to be with a GDP growth of 2% if we have 2% GDP growth in 2013. I am having very strong doubts about that. Here's what happened yesterday. So last night, I'm traveling. I made the huge mistake. It was out of my control, folks, but I fell asleep for 2 hours on a plane ride, which I very seldom do. Unfortunately, that probably did me in for the rest of the night, and I was up, which I wanted to be up because I wanted to watch the football game. Congratulations, Alabama. They made my entire year. I live in Notre Dame country. I can't stand Notre Dame football. I'm not going to lie to you. And I only have one friend that is in the same camp. So he and I had a great time last night, texting back and forth, watching that game. And it wasn't, I can't say it was a good game, but I was glad to see Alabama win. Thank you for that. I apologize to all the Notre Dame fans. But anyway, I was up. I decided to dig in a little bit of analytical work because I had an opportunity late last night to dig into some Asia markets and some European markets. So I get an email in reference to the football game from a friend of mine over in London, works in the financial district in London. So I get an email from him. And we get going back and forth, not only about the football, about the economy. So I asked him for some of his analytical work, not the details of his work or a copy of his work, but his opinion about some things in the future from an economic standpoint. I also had an opportunity to email a friend of mine who used to be a board member here at Financial Issues, on my board, Financial Issues Board, who is the chief operating officer for all of Asia for a pharmaceutical company, and he's living in China. So I had an opportunity to speak with him as well about some economic data, which forced me into some economic, more analytical work, which forced me into rethinking my revised asset allocation models that I just did over the weekend. And basically, if you're a partner with me on the website, you got an alert from me this morning saying, hold your horses as far as that asset allocation model. Now, see, I'm not, I'm just saying one of the problems with analytical work or financial analytical work or analyst, I'll say, is that they're very, very slow to change what they originally said. Because if they change what they originally said, they perceive it as looking bad, changing their mind without just cause or whatever. So anyway, they hang on to something even if it's bad. If you know me, if you have followed me for any length of time, you know I don't do that. Never have, don't believe in it. I don't believe that I was necessarily wrong over the weekend when I did my asset allocation models. What I believe is that my asset allocation models were based on about 3 weeks of hard research that I had been doing. And if you remember, when I put out my alert the day before yesterday, or yesterday, I guess, my alert yesterday was I was saying that it was about a week behind my schedule time to revise my asset allocation model. Well, new data has surfaced. New information has surfaced as a result of possibly, this is just a long shot, possibly the Republican Party getting a spine between now and the next 6 weeks. I'm not holding my breath, but it almost looks as though somehow out of nowhere, there may be a backbone growing. And if that is the case, they may stand up firm against deficit ceiling with the idea of reducing some, having some real cuts in spending and the deficit. We'll see. Not holding my breath. But nevertheless, as a result of that, a lot more economic data has come out, and I've forced me into some other things. To make a long story short, you got my email alert. I want you to be cautious. I've not changed or updated my asset allocation models since Monday morning, but it's possible that I am. So I have just indicated to just hold off, don't do anything, maintain your cash positions.